Hello again. In this next video on behavioural biases, I'm going to talk about mental accounting. Now, mental accounting is how we divide our money up into separate buckets and have different emotions or make different financial decisions based on where that money is and how we perceive it. For example, let's say you win £100, and you're more likely to see that as free money and treat yourself with it compared to £100 that you get in your paycheck. We've accounted for them differently. One's free money, one's earned money, but actually, at the end of the day, it's still £100. And we do this in lots of different ways. It might be that we see our pension funds when we get to retirement as something that needs to provide us with income, because that is what your pension is designed to do, while at the same time we have lots of money that we've built up in savings that we don't want to touch as much because we've built that up and it's in our savings pot, and the point of savings is to save for the future. Whereas it might be more efficient to look at the two together and have a income plan that is making the most of your money and paying as little tax as possible. We also might do it by having lots of money in savings, but at the same time carrying lots of credit card debt, which we're not paying off, even though it'll be much cheaper for us to use some of that savings that is earning a lower interest to pay off debt that we're paying a high level of interest off. Or it might be that we have money set aside for a holiday fund, which has shown some good planning, but we worry about our monthly outgoings, which we're struggling to maintain due to the resources that we have. And the reason why we do this is because money is fungible. That means £1 or £100 is exactly the same. It doesn't matter where it comes from. It's exactly the same value. And we do make this accounting because it helps us in our brains to compute what we have and where and why, and we attach different meaning to these different pots because it helps us to account for where it's come from. Another good example might be an inheritance we've received that we've got from our parents. Now, often I hear clients understandably say, well, we don't want to use this money or waste it because it was mum and dad's money. Understandable, but when you look at it in the total of your pot, it's still an amount of money same as any other source of that money might have been. So a way to overcome this mental accounting is, again, to have a plan for our money and look at our money as a whole and not divide it up into these individual pots. So we're trying to use all the wealth that we can as efficiently as possible. So it's sustainable, we're paying as little tax on it, and we're taking the right degree of risk with all our different pots as a part of a bigger plan. So that's a brief video on mental accounting. The next one I will look at is availability bias.
I hope you liked this video. If you did, please click on the thumbs up button. If you've got views, opinions, experiences that you want to share, please do leave them in the comments section. If you want to receive more videos like this as and when I produce them, please do subscribe. And if you want to know more about how I help my clients plan and live their ideal retirement free of money worries, please go to neliganfinancial.co.uk. In the meantime, thanks for watching.